All right, welcome back to chapter 4 of accounting. This time we're going to be learning about the accounting cycle and what are the rules and regulations that govern this cycle. Okay? So when we talk about the accounting cycle, what is the accounting cycle? It is going to be a methodological procedures. It's a set of procedures that allows us to help us collect and process the information and properly record it. Okay, and of course, there's actual steps to a cycle, meaning you must complete the first step in order to continue on with the next step, right? A cycle is a full circle. Okay, so after you complete the cycle, you rinse and repeat again. All right. And what we do with this is this helps us ensure the accuracy of our accounting. Okay, but what this method does is it helps us conform so we all can use a pathway to properly journalize our transactions. Okay, so again, we're going to be doing that, and it's going to be recording, analyzing, and things that we're going to be doing for a company. Right. Now, again, we had talked about the 4 financial statements. Why is it so important to create the financial statements, right? We talked about it for who we make the financial statements to, right? It's for our external and internal users. But why is it so important? There are 4 characteristics of why it is so important that we create these financial statements, because it, number one, is reliable information, okay? Because the first aspect of, recording a transaction is, well, it has to be reliable information because we need to collect source documents to prove that a transaction has occurred, okay? In this case, right, a lot of the things that we do, especially when it comes to piecing things together, is we have to have some kind of backup or some kind of proof that a transaction has happened, and that's why our the financial statements that we create are going to be reliable, is because we have the receipts, we have the invoices, everything to prove that our information is accurate. So with that being said, right, by collecting our source document, that proves that that the information is true. Okay. Second thing is going to be, it has to be relevant. Relevant is in terms of time, okay? Especially when we're talking about relevancy, right? Especially when it comes to the dollar, right? As we all know, the dollar has changed drastically over a period of time, right? A dollar last year is roughly changed as we know it, okay? It's definitely lost its value over time, right? It's definitely 4 times worth now, or in this case, it's worth 4 times less, all right? Gas is like $6-7 right now, when back then it used to be, roughly $3. So in this case, relevancy is very important, especially when it comes between time. You never want to add a transaction that was 10 years ago in your journal and then have it mixed and recorded with the things that are current, okay? Because of that rule right there, right? Our terms of dollars have changed over time, so keeping things relevant is, well, once we finish a year or so, we close out the accounting period and then start the next year. So we keep our information relevant as possible. Even though we can carry things over, like loans, right? We talked about loans before, right? Loans have anywhere from 3 to 5 to even 10 years on it. That is okay because you're still being relevant with it, because if you're continuously making payments on payments on payments, you're still in the current year, okay? So it's still relevant, and so on and so forth, right? We're going to talk about consistency, okay? Being consistent is very important, especially because in this class, I will teach you many different ways that you can calculate one specific thing. And in order to be consistent, right, you definitely want to stick with one method and not keep flopping back and forth between the methods. But again, especially when we're looking at a business, what circumstances or what kind of means does it tell us to do that this method will work better for our company? Yes, we'll probably need to try it, but at the end of the day, we need to pick one method and stick with it throughout, because that gives us a consistent measure of profitability, right? Or anything that we are testing in the financial statements. Okay, you don't want to switch back and forth from cash to accrual basis versus this costing method and that costing method, and then using different methods. I want to use this method versus that method, right? You want to be consistent because that's going to give us the most accurate piece of information, right? And last but not least, you want to make sure that our financial statements are comparable. Comparable to who? Comparable to other companies that are in the same industry, right? Especially if, again, right, we want to conform, right? We want to make our financial statement stand against another company, because if you compare, right, if my financial statements, right, is all nice and organized and it's clear, okay, then some investor may want to choose us compared to someone else's, which is disorganized. It's not very clear of what the idea is, or there's just too many accounts flopping around. In this case, that's the thing. We want to make it comparable and make it easy to have our external and internal users compare our financial statements, so then they can choose to want to invest in one of us. And on top of that, when we compare to another company for internal users, it allows us to measure up to that company, right? Especially when you're comparing yourself to a company that is very successful. What makes them successful? Why are they so successful? Okay, so that's the purpose of making our financial statements comparable. Okay, all right. So let's go ahead and talk about the 10 steps of the accounting cycle. Here they are, okay? So again, a cycle, which we mentioned before, is a full circle. You need it. Once you complete one step, you're going to continue the next step and the next step after that. You can't go back to another step because it's already been completed. But in this case, I'm going to show you how to be able to go through all of these steps of the accounting cycle by the end of this class. Now, for this class particularly, when we're going to be talking about the very first 10 weeks, I'm only going to be teaching you the first 3 steps. Steps 4 through 10 will be shown, or I'll demonstrate it at the end of the 15 weeks, just because the last 4 steps is going to be part of the closing process, which is chapter 13. And again, the last 4 steps I'm going to show you through the actual fictitious business or the class project that we're going to be doing for the last 5 weeks of class. Okay, because what I need to do is I need to teach you the concept of what it is, why, and we need to journalize it. So that's our main core, is practice journalizing it, and then we'll come together and piece together all the chapters from 1 all the way to 13 and, apply it towards the very end of the class. Okay, so I'm going to walk you through all 10 steps so then you guys are kind of familiar with it. But what I want you for this exam, as well as just in general, for now, I just need you guys to memorize what the order is, okay? Yes, you can remember what they are, but this one, because it's in a specific cycle, the order is very important, okay? I will ask you questions in regards to the order of the accounting cycle, not what is in the accounting cycle, okay? So step 1 is to collect and verify the source documents. So in this case, right, that is, again, proof that a transaction has occurred, and it gives us a lot of information, okay? So what are we looking for when we're looking for collecting these certain documentations? Well, they could be a receipt, they could be an invoice, they could be a checkbook, right? A bank statement, right? Contracts that you have signed between two individual people, because in that contract, right, it displays a lot of information in regards to what the transference of money is going to be about, right? So again, these are very important documentations. Now, where do I put these actual proof of documents? You do have a couple ways, just because we are, moving into the digital age. You can photocopy, scan one. You can take a picture of it, right? It's not necessary you have to actually physically keep it, but there are, I know that for sure that there are a lot of places that have filing cabinets, right, that print exactly copies of the receipts and so on and so forth, right? And they make copies, they scan them, and they make copies of the documents, the invoices and so on and so forth, right? You have it available, all right? And then they file away in a cabinet, and once the year has been gone, you have to actually hold on to it for a couple years, I believe. There's a holding period of how long you have to hold your financial statements and reports for, okay? So once again, you also might need that once again, for in case you get audited, okay? Well, there you go. So once you get your proof of your transaction, we can move on to step 2. Step 2 is going to be analyzing and sorting our data, okay? Well, in this case, right, so here is an example of a receipt. The receipt tells us all the information we need to know about the transaction, right? It tells us when the transaction happens, right? Because it's always time-stamped. Every single document will have a timestamp, okay? All right, whether it's a document, a contract, a receipt, an invoice, they're all going to be having a timestamp. So you will 100% know exactly when the transaction happened, okay? Now, what has happened is what you're going to be determining. In this case, well, this is a receipt from an office supply store. So obviously, it's very clear. What did you do at the office supply store? You bought office supplies. Straightforward, okay? So in this case, yes, I bought office supplies. What kind of office supplies? It's listed on the receipt. So if you want to break it down by items that you bought, or you want to categorize it all into one, you have all the information that you can to be able to process what you did from this receipt, okay? Then the last section is going to be how, okay? How is going to be how much, what did the whole thing cost, and how did you pay, okay? That's very important, because, again, you want to make sure, okay, well, in this case, we got down to is $61.09. As we could see, we got charged sales tax, so therefore we would have to distribute that. So in this case, how much is $61.09? How did I pay? I paid with cash. Right? I gave the cashier $62, and they gave me 91 cents change. Right? So in this case, that's exactly what I need to do. I'm going to record. After I analyze and I sort my ideas, right? So in this case, I know that I bought office supplies and I used cash to buy them. So therefore, we're going to be using the 7 steps of transaction analysis once again. And then once we figure it out, then we can go ahead and move on to step 3. Step 3 is now journalizing, right? Which is step 7 of the transaction analysis, saying we got to just journalize it in our journal. Okay? So here, right? We purchased office supplies, so that means we increased our assets, right? And then we had to spend our cash, so therefore we must decrease our assets. So in this case, we purchased our office supplies for $61.09, okay? And we spent $61.09 for it with cash, okay? Once you have this down, right, in this case, again, the journal is only meant for our daily business transactions. We don't even know what our account balances is. So then that is exactly why after we complete our journal, we need to plug it into our ledger, okay? The general ledger is going to give you your account balance. So again, it's a list of every single account that exists in your chart of accounts, and it's going to have their respective account balance. All right, so for instance, we can see here my cash ledger account. You can see that when I began my my month transaction, so as of June 1st, I started out with $2,000. So that means I have $2,000 in my bank. But because I end up buying, or I have $2,000 cash on hand, but because I end up buying office supplies on June 6th, therefore, that information says, well, I spent $61.09. So therefore, I'm going to subtract it out of my total amount that I have, and now I'm left with $1,938.91. This gives you a running balance. So that means that's how much cash I have now after the transaction has occurred. All right? But then I also have to tap into my other account because I've increased my office supplies. So here you go, right? Because office supplies, I didn't buy any as of June 1st. Therefore, when I pop in, putting in office supplies as of June 6th, now it's telling me I have $61.09 because I debited. So therefore, it's going to increase my office supplies account by $61.09. So again, this tells me I made the purchase, I've increased my accounts, and this is where I'm at in my accounts. Okay? Now, once you've done this, the next step is very crucial because you need to complete your general ledger before doing the next step, which is going to be creating your trial balance, okay? So all of these numbers that we have here are going to be the list of every single account that exists in your chart of accounts. And what I'm going to do is I'm going to take the account balance from my ledger and I'm going to apply it into this little table here to measure and to test one thing and one thing only. Does my total debits equal my total credits? Okay, so this is separate from our journal. This is separate from everything else because what this does is when you put a transaction in, right? We use the double system entry, right? Where we have an equal and opposite credit, right? But as we transfer information from the general journal to the ledger to the trial balance, there are, we have a possibility of forgetting, or we might accidentally put a typo in, okay? But the real issue here is that we're trying to test that while you were doing your accounting, were you accurate? Okay, especially if you're transferring from one account to another, right, using the double entry system, right? I went from a cash account to an office supplies account, and then I had to post it into my general ledger. Did I calculate those numbers correctly? Did I forget to post to my general ledger? Is going to be why your trial balance is going to be not matching. Right? Hence the word trial balance, right? We're looking at your account balance. What was the ending balance at the end of the given after all the transactions have been done, right? So that's where you will plug these numbers in and every single account, right? When we talked about the accounting model, they all had a normal balance, right? your checking account is most likely going to be increased by a debit, right? Okay, that's where I see now everything is starting to piece together. So once we have that, then we put them all in here to test to make sure that when we were transferring our debits to credits or our credits to our debits, right, did we do it correctly? And we would know if the total debits and the total credits do not match. But in this case, they match right here, $3,860 on both sides, okay? So once we've completed that, then we have to reach the end of the accounting period. So then now we have to make our adjustments, okay? These adjustments will always happen at the end of a given accounting period, okay? So in this case, we do monthly statements, or we do monthly accounting periods or accounting cycles, right? So in this case, at the end of the month, you're going to have to adjust your accounts accordingly. Now, on the left here are going to be a list of examples of adjustment entries that you will need to know, okay? And these adjustment entries are going to be taught in the class, right? We're going to talk about periodic inventory, right, in chapter 5 and chapter 6, right? We're going to talk about depreciation, right, in chapter 11. We're going to talk about supplies expense. That's going to be chapter 13. We're going to talk about cost of materials, which is going to be also chapter, that could be various chapters here. And bad debt expense, which is chapter 10. Okay, so all of these adjustment entries are things that we will cover in the future. Okay, but remember, I'm only teaching you steps 1 through 3 as of now. We're going to learn all of these steps as we go through the rest of the accounting class. So here, I have to make an adjustment to my office supplies, right? Because in this case, right, I purchased them, right? But why do I need to adjust them? Well, in this case, if you buy office supplies, are you not going to use them? Right? You're going to buy office supplies and let it sit in your office, right? No. You're going to open up the box, or you're going to open up your supplies and you're going to use them, right? And when you use them, we call that an expense, right? Right? When you get rid of, use, or spend money, right? So in this case, that's exactly what we're doing. We're going to adjust our expense, adjust our assets to reflect what we actually still have versus what we used, okay? And then we talked about depreciation, or at least a brief of it. When you buy fixed assets, they eventually lose their value over time because you're using the machine. They're not going to ever hold their value because it doesn't make any sense. If I buy a printer and I used it, do you think I can sell it back for the same price I purchased it at? You could absolutely say no, because you used it. You opened the box, you ran the printer, you used it. No one's gonna want to buy a used printer at full cost. So in this case, that's where depreciation is gonna come into play, and that's why we must adjust our accounts accordingly, because we cannot say that our asset is still worth the same. Okay. So once you do your adjustment entries, right, that's where you're going to be completing a adjusted trial balance, okay? Now, because we use the journal, right, that means we have to go back through everything again, right? We use the journal, so therefore we got to post it to our ledger, and when we post it to our ledger, then we must do our trial balance, okay? So again, this is going to include, after we've made our adjustments, did we correctly adjust our accounts accordingly by transferring the proper debits to our credits? Okay, so again, our goal here is to make sure that our total debits match our total credits after our adjustments have been made. Okay, once you've done that, then step 8 is going to come into play. Step 8 is where we're going to start creating our financial statements. Okay, so the financial statements is actually going to stem from our adjusted trial balance. Okay, so every single statement is going to go in our particular order. We're going to start off with our income statement because we need to figure out, did we make a profit or did we make a loss? Because that's going to determine whether we need to adjust our equity accordingly. So in this case, once we, again, collect all of our revenues, right, and counter them against all of our expenses, we're going to determine, do we get a positive or a negative number? So in this case, we got a positive number. That means we got a profit. Now we have the choice, especially when it comes to a profit. You have a choice. Are you going to reinvest into your company, or are you going to pocket that net income, that profit? So in this case, so here, if we choose to reinvest, this is what happens. We're going to plug it into our statement of equity, right? Because when we have equity, we start off with a balance at the beginning of the month or beginning of the year, right? So in this case, I got $2,000, okay? And then we're going to either add net income or subtract it, depending what it is. If you are reinvesting, you're going to add net income because a profit's going to increase the value of your company, but a loss is going to decrease the value of your company. And of course, any other contributing fact features. So again, if you had extra investments, that's going to increase, but if you withdrew from the company, it's going to decrease. Okay? So here, I only had a profit of the $309. So then now my company is now valued at $2,309.17. Okay? And then once this step is done, we need to move on to our next statement, which is going to be the balance sheet. Here, right, you're testing the balance, the accounting equation, right? Your assets must equal your total liabilities plus your equity. So in this case, the balance sheet is once again going to come from your adjusted trial balance, right? Because this is going to list out all of your assets. It's going to list out all of your liabilities. However, equity will be given from our previous statement, okay? So that's why it's very crucial that they do go in our particular order. Income statement first, then statement of equity, then statement of the balance sheet, okay? Because here, equity should be given to you automatically. So in this case, my equity was $2,309 because I didn't have any liabilities, and my total assets were also $2,309.17. So once our balance sheet is complete, right, and our accounting equation is equal to each other, right, they're balanced, then we can move on to our statement of cash flows, because what the statement of cash flows is, it's a combination of your income statement and your balance sheet. So you need to have those two complete in order for you to be able to complete your statement of cash flows, okay? Now, again, the statement of cash flows is going to be taking an aspect of how much actual real cash flowed into your company and how much real cash flowed out of your company, okay? So we're going to be comparing all of our assets, liabilities, all of our equity accounts, right? And we're going to counter them against our net income or net loss. So that's where you need to complete the income statement, because that's where you're going to get that piece of information in from. Okay? Because as we go through this, right, when we purchase our assets, that's part of investing into our company, right? And then anything else when it comes to equity, right? Did we have investments, right? Did we put more money into our company? Did we take money out from our company? And that's going to be your financing activity, okay? So on and so forth. And then what you're going to find out is your beginning balance of cash, right, from the beginning of your accounting period. It should be matching along with the total amount of cash that you have at the end of the accounting period, okay? So that's the purpose of this, to see where your money is actually going, okay? Once we completed our financial statements, then we go ahead and proceed to step 9, which is to close the books, okay? When we close out the books, what we're doing is, if you remember from chapter 2, we're going to close out our temporary accounts, meaning we're going to zero out my revenues and my expense accounts, okay? Now, when we learn about what debits and credits do, right, it's just like a scale, okay? If you got the one on the left side and you got the one on the right side, right? Or a number line, however you want to look at it, okay? If you put too much on the left, right, how do you balance that out? You would either put stuff on the right or you transfer it over to the right, okay? So when we think about debits and credits and we think about the balance, what it actually does is it's on a number line. So if you go left 10, how do I make it back to 0? You have to go right 10, right? So in this case, we have to understand it like that. How do I zero out my sales account and how do I zero out my expense account? Well, in this case, right, if we normally know that sales, right, in order to record a sales, it's normally a credit balance because we are going to zero it out. We're going to debit our sales account and we're going to dump it into an account called income summary, okay? Income summary, if you ever read this anywhere else, it's also known as your retained earnings, okay? They're the same, except their difference is what kind of business organization are you? You would never have a retained earnings if you are a sole proprietor, but it is referred to as a retained earnings, okay? So there you go. You got sales, and then you're going to debit your sales and then credit them into income summary, and then you're going to credit all of your expenses into the income summary, right? And the last thing you have to do is you have to close out any equity accounts. So if you borrowed money, took money out, or added money into the equity, you have to zero them out as well. Okay? Once you've done that, then the last thing that you need to do is to ensure that you properly closed out your revenues and your expenses properly by running your closing trial balance, okay? Now in this case, your equity should end up equaling the equity that you've figured out in your statement of equity, okay? And then again, your assets and your liabilities are going to be the same, okay? And then again, at the end of the accounting period, again, your total debits and your total credits should match, right? And that is all the 10 steps of the accounting cycle, okay? Once you're done, right, you're going to have to repeat that cycle over and over again for the rest of the company's life, okay? And that's the accounting cycle, all right? So in this case, my accounting cycle started June 1st and ended June 31st or June 30th. So that means the next accounting cycle is going to be July 1st and it's going to end July 31st, okay? So that's this accounting cycle, is that they do it every single month, okay? Any questions? Okay. All right. So let's talk about the accounting period, okay? Your accounting period, okay, can be broken up into many different ways, okay? Well, let's start back first. What is the accounting period? It is going to be when you choose to schedule to complete the accounting cycle. Okay, so the previous example was every month. Okay, now in this case, you could do it however you like. If you want to do it every day, go for it. If you want to do it every week, every month, every semi-annually, every annually, you have the choice. Okay? Now, if you really think about it, think about your company. If it's really small, then yes, doing it every day, every week could be possible. Now, if you're thinking about a major corporation such as Walmart, do you think you're able to do it every day to close out the accounting period? If you look at all of those steps, that was a lot of steps. 10 steps to do every single day. Is that possible? Probably not likely because, again, who's going to be the one that's going to keep track of all the sales that you made that day? Who's going to be keeping track of all the expenses you made that day? Okay? It's a lot of work. Okay? And that's why most corporations or most companies, they would usually do it on a month-to-month basis. They could even do a quarterly statement. Or I know for corporations, they release quarterly statements and then they release the end of the financial year annual statements. Okay? But again, a perfect way to measure profitability is, once again, we are doing it for ourselves, right? For our internal users to measure our success, right? Are we progressing? So the best way to actually see a good overview of the business is a monthly, wrapping up and closing out your accounting period usually is the best way to do it, just because, again, month to month, you can compare your business on how is it progressing over a month. Okay? Doing it every day is not going to really help you, and doing it every week is also not going to really help you. But every month is a pretty fair choice. Okay? Now, are you obligated to choose one of these options here? Yes, of course. You need to choose. Are you going to do it every day? Or are you going to do it every month? Whichever one makes it easier for your business, okay? But if your business is super, super small and you're only doing transactions like maybe once or twice a week, then you're better off waiting till the end of the quarter to do something like that. Or you could just do it at the end of the year, okay? So that's the accounting period. Now, what is calendar year versus fiscal year? This is in terms of when you file for the IRS, because they want you to file every year. So in this case, at the end of the day, you still have to complete your accounting cycle at the end of the year anyway, because you can't do 5 years, 10 years out. It has to be done at least at the end of the year, okay? So in this case, they want you to do that so that when you do file for taxes, right, that's normally an annual thing. So they give you the option to choose. Would you want to file as a calendar year, or do you want to file as a fiscal year, okay? What's the difference? Calendar year is straightforward. You're going to start from January 1st and you're going to end December 31st. This is the most easiest and the most recognizable type of accounting, just because it is easy to remember, right? Oh, it's January 1st. I'm going to start my accounting period. And then at the end of the year, I'm going to close it out by December 31st, right? Straightforward, right? And then I'm going to file between the time. Now, in this case, most companies actually are calendar year. Now, you could actually also do fiscal year. So you have to choose one or the other. You can't have both. Fiscal year is where you're going to be determining any 12 consecutive months, starting on the very first of the first month and ending on the very last day of your 12th month, okay? So again, a lot of government agencies, they start their fiscal year as of July 1st and end it on June 30th, okay? That's because for governments, right, especially federal or state, they function better like that. And I'll give you an example, okay? Why would they function better for a fiscal year than for a calendar year, right? What do we always have? Usually in November and December, right? We have laws that change, right? We have new tax years. Sometimes that very year, you might have to elect a new president, elect a new officer, elect a new senator, right? That means the business is super busy during November, December, January, okay? Because they're trying to transfer everything over, all right? And they're trying to make everything work, okay? Especially agreeing on the tax tables, agreeing on these laws, and so on and so forth. So they're very, very extremely busy during the winter season, okay? However, once they get to the summer, right, where usually nothing happens, then that's a perfect way to be able to, one, close out your accounting cycle, and two, that's the perfect time to file taxes because you're not busy, okay? So that's the example for a government agency to use the fiscal year. Now, for example, another example is going to be for a calendar year is, think about it, a swimsuit company, okay? Swimsuit season, right, is usually between the spring all the way to, the summer, right? That means you're most likely going to be busy between the months of, May, June, July, August, September, right? That means it's better off for a swimsuit kind of company or bathing suit company to work as a calendar year because usually during the winter, yes, there's some winter sports, but if we're tailoring to the general public, no one's going to be swimming in winter, okay? So that's why they would say, okay, well, my business usually is booming during the summer and spring, but as it gets to the fall and the winter, it gets colder and so on and so forth. So therefore, business is slower during the winter. So therefore, that's the perfect time for this business to file for, to wrap up their accounting period, right, and wrap up their accounting cycle and file taxes as of January, right? Because again, a lot of most companies, right? Why do they always give you your W-2 form by January 31st? It's because most companies are typically calendar-based kind of companies, where the only exception to that would be your your fiscal year, where they're tailored towards using their they start sometime in between, as long as 12 consecutive months. Okay. All right. Any questions here? Okay. All right. So let's go ahead and talk about the generally accepted accounting principles. Okay. What are these generally accepted accounting principles? Okay. These are the rules and regulations that the government tells everybody that they have to follow for processing their financial statements and financial forms. Especially, this is more geared towards for corporations, right? They boggle down on them for it, okay? However, right, as a company, right, especially in the United States, they expect every single company to follow these rules and regulations just because, again, they want to have some kind of unity, some kind of conformity where everybody is filing everything in a certain way. You don't want to have someone following GAAP, and then you don't want someone to file something else completely different. No, we want to create some kind of uniformity, some kind of clear rules, standards, procedures, and so on and so forth. So again, the IRS doesn't create this. It is the FASB. Okay, what is FASB? It's the Federal Accounting Standards Board. Okay, FASB for short. Okay, now FASB is the one who creates these financial reports. So again, they are the one who created the GAAP. Now, Here's what's even more funny. GAAP is only used in the United States of America. Okay? That's why it's called US GAAP, not just GAAP. All right? So that means if you're trying to do a business in Canada, you need someone to be in the professional areas of what Canada does, because their rules are going to be different than our rules, okay? And so on and so forth, right? So in this case, the US GAAP is going to be the rules and standards that we learn here in the United States, okay? And it's governed by FASB, okay? Now, this is why we need an international person to be able to do financial reporting, because they need to know the ins and outs and rules of international accounting rules, right? Now, another big organization that is prevalently used for most European countries, as well as some southeastern countries, I believe China has a separate one itself, is going to be the IFRS, okay? IFRS stands for International Financial Reporting Standards, okay? IFRS, okay? And that is going to be in terms of international businesses. So again, it's mostly used for European countries and some countries on the Middle East and so on and so forth, okay? Now, that doesn't necessarily mean that all countries are going to be doing it, but most countries do follow the IFRS. United States, we don't do that. Now, again, the IFRS was created by the International Accounting Standards Board, which is based in London, England, okay? So again, the state capital of Europe, I guess you can call that. They're the ones who created these standards boards to report your financial statements, okay? So it is drastically different from the US GAAP, okay? That's why you need a professional to be able to understand the difference between our rules and their rules, okay? Now, this is what I've been hearing, and I definitely don't think it's anytime soon, but since I was in school back in 2012, I was told that the United States and the IFRS were trying to work their way together to create a universal standards for accounting, okay? So then it's easy for everybody to work, because they're all going to be on one one standard and one rule. In this case, because the complexity of the difference between the GAAP rules and the IFRS rules, they're still working on it. Now, is it still going to be? I don't have a clue, because fast forward, it's 2022, right? It's been almost 10 years since I had my last class telling me that they're working together to create one universal standards rules, reporting standards. In this case, I don't see it's working anytime soon. But in this case, yes. So these rules, so make sure that you are careful, especially when you're doing research, because you could be reading up on the IFRS, not the US GAAP, okay? All right, but because we are here in the United States, I'm only going to show you the US GAAP, okay? I just wanted to let you know that there are different reporting standards out there in the world, right? And that's why you need those international accounting. But in this case, this is the largest reporting standards that exist that most countries do use, okay? All right? So let's go ahead and dive right into US GAAP. US GAAP is actually split into 3 different sections. You're going to have your assumptions, your principles, and you're going to also have some constraints. But let's break it down one at a time, okay? So let's talk about the assumptions first. Number one is going to be the business or economic entity, okay? What this tells us is if you are going to be going into business, whether you're a sole proprietor or whether you're a corporation, you need to have a clear division of knowing the difference between a business transaction versus a personal transaction. You need to have a clear way to be spending stuff for a business versus spending stuff on yourself, okay? And that's the huge rule because, again, as a sole proprietor, it's easily to say, oh, I can write my personal expense as a business expense because it's going to come off my taxes regardless. No. If you do that, that is you, yourself, frauding your own company. All right? And again, we talked about sometimes, yes, anybody can say, I own a business. Anybody can apply for a sole proprietor. But there are rules and regulations, right? We said, you think you can't just get away with that because you think it's a huge tax break. No, you need to invest in yourself. You need to create a profit 3 out of the 5 years, or else you're going to be considered a hobby. And that hobby is going to be detrimental to you for your personal income tax. Okay? So in this case, right, so the example is having a separate bank account. That one's the most obvious one. One that's for your business bank account and one is your personal bank account. Now, if you are a sole proprietor, yes, your name will be written on your business bank account because you have to be the one to authorize it, okay? But that's not the same thing as you going ahead and authorizing your own personal expenses, right? A business card is strictly used for business transactions only, you can't use it for your own personal expenses. Okay, make sure you know the difference between that. Just because, again, if you go through the auditing process, you could be audited and you could be fined because you used your business to buy yourself personal stuff. Okay. All right. Yes, there are some rules and regulations that you can get around it. So again, obviously, if you own the business, right, then your job is to take money away from the business and then put that money into your personal account and then take that personal account to buy whatever personal items that you want, okay? That's the correct way to do it, okay? Because in this essence, right, you're the owner of the company. The money that's the business is your money. But again, you want to be very careful with doing that because, again, if you fault on your business, your personal assets are at risk. Okay? Number 2 is going to be the going concern. Okay? Going concern is going to mean that even if there is a foreseen event that's going to happen in your company, so again, a foreseen foreclosure, right? You are still going to continue doing business as usual. Okay? You're going to still carry out the obligations and the business responsibility until the day that the business is closed out. Okay? So, for example, right? Sears, right? Sears is a very huge company that's been going on for so many years. Even though they filed for bankruptcy, and so on and so forth, they have to liquidate their assets and so on and so forth. They still have to continue selling their items, their inventory, right? Because they're trying to get rid of it, right? They still have to continue their operations and continue selling their items, right? Until the day they completely close, as in the doors are closed, lights are turned off, and so on and so forth, right? So in this case, right, oftentimes when you do see that kind of thing where a store is closing, they're trying to get rid of everything that they own, right? They're trying to liquidate their assets and try to, prepare for closing. So they're going to have a whole bunch of sales, right? 75% off of furniture, yada, yada, yada. They're trying to do everything that they can to get rid of their inventory, because what's going to happen when they close out and they don't sell it? It's just going to sit there. So in this case, that is exactly what a store does. Even if there is a foreseen foreclosure, you're still going to carry out the business obligations and operations as normal. Okay. Number 3 is going to be monetary assumption. Monetary assumption is split into 3 subcategories here. So in this case, you got number 1 is going to be monetary unit. Monetary unit is going to be in terms of having some kind of currency that you're going to be using for your books. So in this case, we live in the United States, so therefore our standard form of currency is going to be the US dollar. Okay, straightforward. That means every time I record something, it's going to be in terms of dollars. Okay. Number 3 is going to be monetary measurement, okay, where all events are recorded in terms of money, okay? So a great example of that is going to be that, well, if my company has 20 employees, right? You can't record that you have the number of employees, right? You can't just say I have 20 employees. You have to record them as a total cost. Okay, so in this case, if I have 20 employees, they're going to cost me $100,000. Okay, all right, so that's the idea there, is when you are recording your transactions, you can't record quantity, you have to do total cost. Okay. And then last but not least is going to be stable currency, which is going to be a unit of currency that is stable and that, of revenues that ignores the adjustments that are necessary when you have inflation. So again, over a period of time. So in this case, right, we talked about how the US dollar, right, is a stable currency that we use. It used to be backed up by the gold, right? By the gold standard. Now I believe it's backed up by crypto, if I'm not mistaken, by invisible money. Okay, so yes. Now again, what our stable type of currency is, the why we use it is because, think about it, the US dollar, okay? Even though it has definitely expanded, it fluctuated over time, to us, a dollar is still a dollar, okay? We don't actually look into the real pennies of it, right? We don't actually look at how much it increased or how much it decreased, right? All we know is a dollar is a dollar, okay? But the society, right, especially when we look at economics, we can see, well, the dollar has definitely lost its value, because now bread is no longer 30 cents, it's $3 now, okay? So that's in terms of looking at the dollar there, but in our eyes, the US dollar is still $1, okay? And how we can use that to apply for the future is we can use it to measure if we want to do investments, right? Because a dollar is still going to be a dollar in 10 years, okay? So that's why we have to use some kind of form of currency to help us use it to measure for the future, right? And the US dollar is going to stay a US dollar in the future, right? Unless they start printing out 50-cent coupons, right? So in this case, that's what a stable currency does. Okay? And then last but not least is going to be number 4, which is the accounting period. So here the United States GAAP tells you that when you do your accounting period and you schedule your accounting cycle, right, this GAAP allows you to break your accounting period into, right, daily, monthly, weekly, right? Because the essence of that is to help you measure the progress of your company. Okay? So in this case, that's exactly our example here, is that we would use a monthly accounting period to measure our profitability in the span of a month basis, okay? And we can see how our profits and things grow, right? Right? Any questions in regards to assumptions? Okay. All right. So the next one is going to be basic principles. Basic principles are going to be these four here. Number one is going to be the historical cost. Okay? GAAP tells you that when you acquire anything for your business, usually if you acquire fixed assets, patents, assets in general, your standard rule of thumb is you must record it at historical cost, okay? So again, I'm going to give you another example here. This is one of the things that you cannot ever do, especially when you're thinking about property management versus accounting, okay? They're two separate things, because when you buy a home, right? If you buy a $100,000 home, it's going to be in your books for $100,000 until the day you sell it. Now, if I had my home for 20 years, right, as an accountant, it's still going to be worth $100,000. But as property management, right, it's going to be worth $500,000 because you gain equity, right? And that's why I keep telling you, when you record historical costs, the reason why they do this is because you cannot add invisible money, all right? You cannot miraculously have money change in your books, right? You can't assume that your business went from $100,000 to $500,000 with no transaction, okay? So that's the rule there, where under, property management, we already accepted the gain. We already said my house is worth $500,000 now. Okay? If I choose to sell, that's where I choose, am I going to take a loss? Am I going to sell it for more or sell it for less? Okay? But on the property management, I can record my house as $500,000 instead of $100,000. Okay? So that's why we got to throw that idea out, because in this case, accounting it will stay $100,000 no matter how long you've had the asset, okay? Even if you depreciate the fixed assets, okay? So very key important here is that you need to know. It doesn't matter what it is. The only exception to this rule is going to be inventory and if you buy securities, okay? So again, the example here is going to be that you purchase a $50,000 machine. That means it's going to stay in your books at $50,000 until you plan to sell that machine. Okay? Now, hold up. Why are securities and inventory going to be an exception to that rule? Think about it. A bank security. You're purposely buying a bank security, right, with the purpose and intention for it to grow and miraculously have a value on it. Now, you can't record it until you redeem it, so that's one thing that you need to know. But in this case, yes, they can. That's the purpose of buying a bank security. Okay, inventory, and we'll talk about this in chapter 6. As we buy inventory, right, especially because the vast majority of we're living in a huge technological world, that means not only technology is advanced, we also live in a consumer society where all we think about is buying the latest and the greatest. So therefore, things become obsolete, okay? So for example, right, iPhones. They come out with a phone every year. And then people who are still back in the times, right? I'm still using an iPhone 6. Am I out of am I out of season? Yes, but that's because I don't need to have to get the latest and greatest. But because that's the thing, as it progresses, right? That means the iOS whatever for that iPhone 6 is no longer available. So that will force me to have to upgrade to the later and greatest phone, okay? Because it's obsolete. So if something happens to my iPhone 6, they can't fix it. They can't do anything about it because they stopped the production for it. So in this case, that's an example for inventory where if I still carry the iPhone 6, it's probably worth $50 for scrap metal. Okay? It's not worth anything anymore because they don't exist anymore. Okay? So that's what we're going to teach you in chapter 6 is how do I adjust my inventory due to the market. Okay? All right? So then number 2 is going to be revenue recognition, also known as realization. Okay? So this is going to go into the laws of accrual basis of accounting, and we'll talk about what that is towards the end of this chapter here. This tells me that when a sale has occurred, I'm going to record it the minute I earn it. Okay? So for example, if I sold an item or a service, okay, at time of the sale or of the product, right? The product has been sold. It's gone. It's no longer there. The service has been done. It's been completed. So in this case, I have to record it. And that's revenue recognition right there. Even if I received money or not. You already provided the service. It's been done. It's completed. You need to record it as revenue. Okay? And this one is going to go hand in hand with the matching principle because for you to record that revenue, what were the matching expenses that you had to do in order for you to gain that revenue? Okay, so the example is when you sold that product, right? The sale is going to have things like a cost of goods sold. So how much did it cost me to acquire the materials, right? What was the profit margin that I added to the sales price for me to be able to do that? And this is where you have to match your revenues with your expenses. Okay, hence the word matching. Right? So again, in order for you to be able to recognize your revenues, you need to know what the associated cost of goods sold and so on and so forth to be able to recognize and have the equal debit to the equal credit for the matching principle to be applied. Okay. And then last but not least, we have adequate disclosure, okay, where all other information that is related to the business transaction is going to be disclosed to the notes to the financial statement, okay? This one is for people who are in the professional of making financial reports and stuff. But in this class, I'm only going to teach you just to, I'm not going to teach you to build an actual financial report because it is long. It is very intense. But in this case, this is going to be a place for you to put in all the extra details that are in regards to a transaction. So again, going back to the example where we had 20 employees, right? So the notes to the financial statement is where you're going to record the number of employees. Again, you're also going to disclose, right? Because not all of your employees are going to be on the same payroll, right? Some of them are going to be salary-based earnings. Some of them are going to be wage-based earnings, okay? And you don't need to put names or anything in there, but you should put why these people are, for example, this person's salary-based earnings because they are the CEO, right? This is how much money they make. Whereas a regular employee who is a standard 8 to 5, right, regular common law worker, hourly worker, their pay rate is $10.50 an hour, and I have 3 of them, okay? So that's where you're going to disclose. You're not going to disclose names or anything like that, but those details is what makes up your total amount that you have. Because in this case, if I recorded in my books that I have salaries and wages expense for $100,000, does that tell me anything? That tells me I spent $100,000 paying my employees. But does that tell me that I have 1 employee, or does that tell me that I have 20 employees? And that's where the notes, the financial statements, is going to help you. Okay? Any questions in regards to basic principles? Okay. Last section is going to be constraints and conventions, okay? This one is actually going to be very more tailored towards manufacturing or cost accounting. Not so much for financial accounting. This is more for more advanced levels of accounting. However, you still need to know at least what they are and etc. Okay, so the first one is going to be materiality convention. So in this case, is a transaction, or is this a transaction even important enough to record? Does it affect your business at all? Now, again, we talked about the transaction steps of recording a business, right? Transaction, right? But in this case, is it worth it? Now, what do you mean, is it worth it? So let's give you an example, okay? I buy a $5 trash can for the office, okay? Is that worth it to record as a fixed asset and have to depreciate it every single day? Is that something you need to record? No, you can just write that off as an expense, right? You could say I bought something as a business expense, right, for that $5 trash can. Whereas, what if I end up buying a $50,000 or a $10,000 machine? That right there is going to affect your business a lot. So that's what materiality does, is it basically determines, you have to have the executive decision. Are you going to record the $5 trash can, or are you going to record the $10,000 machine, right? Which one is going to be affecting your business in the long run? In this case, that $5 trash can, you can just write it off as a business expense. Okay. Number 2 is going to be the cost-benefit convention, okay? So very similar to the idea of cost-benefit, right? You are comparing the costs and what the benefits are for those costs. So in this case, right, you're going to have a couple alternatives, right? So in this case, here's an example. One alternative, right? If you are in the business of producing shirts, right, or producing something, a product, right? Option 1 is, if you produce it in the US, it's obviously going to cost you higher, right? Because the price in the US is a lot more expensive. But, however, the benefit is that you could get a 24-hour turnover, meaning it will be shipped to you and sent to you within 24 hours, right? So then you can go ahead and sell those items within that week, right? Or you have option 2, where you can send it overseas, right, to get it produced there. However, due to, customs and, the processing of shipping it overseas, right, your turnover or wait is going to be anywhere between a week or 2 weeks, right? So that means even though it does significantly cost a lot cheaper, right? We all know labor in other countries is 100% a lot cheaper, right? Than it is to do it here in the United States. But however, the turnover time is a lot longer. So that means you're not going to be able to sell those instantly. So those are the two options that you have to choose between, right? Pay more and be able to turn around and get the money instantly, or pay less and have to have a waiting period. Then you can sell your items for whatever price, okay? So that is the cost benefit, where, again, this is more for operations, right? More for managerial, cost of counting, where we're looking at the cost and how much is it going to benefit us if we choose one of those alternatives, okay? And this also goes hand in hand with the conservation or conservatism convention here, okay? Which is number 3, which is going to be, you are going to be choosing the alternative option that is least likely going to overstate your assets, okay? In this case, I'm going to give you a different example. Because in this case, right, when we go through sales tax or tax in general, right? And because tax is, it's like 8.375, right? You're going to get a lot of digits after that number. Now, for this rule here, right, what you're going to do is you're going to round either up or round down. Now, in this case, when it comes to sales tax, you're always going to round up because it's the government. They want their money, okay? However, when you're calculating your inventory, you're always going to round down because at the end of the day, you don't want to overstate your assets. Okay, so if you have, when we dive into periodic inventory, right, and we have that split penny, right, are you going to choose to round up your cost, or are you going to choose to round down? And the rule here is you should round down for your cost, right, because that's going to, again, benefit other people, right, and not yourself. So again, it's going to least likely to overstate your assets. Okay? And then last but not least, number 4 is going to be industry practices. Okay? Industry practices is going to be talking about comparing your statements to someone else's, because if they are doing something better, you are most likely going to be tailoring yourself to want to become that status, that level. See what makes them do better, right? So in this case, usually people that are in the same industry, they don't work together, obviously, but again, we are looking to compare ourselves. How are they doing business much better than we are? Okay? And an example will be any kind of coffee shops, right? So we got Dutch Bros, we got Starbucks, we got Dunkin' Donuts. All of those are going to be coffee shops, right? They all do the same thing. They sell coffee, they sell cappuccinos, they sell baked items, bakery items. They sell breakfast items. They do a lot, okay? Now, in this case, right, what we're going to do is these companies probably did compare themselves to each other, right? Because all of these are all in the same industry. They all serve coffee. They all belong in the same industry, right? So what are they doing that's selling, or what is their part of their business that's doing very well? And again, they might be comparing their own financial statements, because again, if you are going to be opening up a coffee shop, you want to be at that point where you are as successful as Starbucks, D-Chicks Coffee, Dutch Bros, right? So how are you going to get yourself up there? It's going to be using industry practices. What have they done better that you could improve yourself because you want to be at that status, right? That's industry practices. So again, Maybe they do the cost benefit too. Maybe they outsource their coffee beans too. Okay, so that's that. So again, when we're talking about all four of these conventions and constraints, we're actually talking about looking at a managerial slash cost accounting or appeal, or in this vision, right? So in this case, again, a lot of these have to do with decision making, which is managerial, right? And then also boggling down on the cost, right? And comparing ourselves to other people because they might be doing something that's better than us. Okay? Any questions in regards to these constraints or conventions? Okay. So we're going to stop here because it's 9:51. It's perfect for you guys to go on break.